Morning, my dear friend Bhupesh on this side. So today we'll be starting with study session 11. So please take out your register, study session 11. I'm going to start with study session 11, corporate finance. There are two study sessions. In corporate finance, 7% is the marks weightage as per CFA curriculum level number 1. And we will cover two study sessions in this corporate finance. One is study session number 10 and second is study session number 11. In this there are three readings: reading number 34, reading number 35, reading number 36. When I say reading number 34, I mean corporate governance. When I mean reading number 35, I mean capital budgeting. When I say reading number 36, I mean cost of capital. So today I will be starting with study session 11, and in that there are two study sessions. One is 37, reading 37, and second is reading 38. So let's start. Let's start. Let's start the game. Let's start the game. Study session number 37, study session 11, reading 37, and reading 38. These two readings are very important and very easy and very short readings. When I say reading 37 and reading 38, or the heading of study session 11 is leverages, leverages and working capital. These are the two concepts which I will be covering in these my lectures. That is leverages and working capital. Leverages and working capital. That what is the meaning of a leverage? When I say a leverage, what is the meaning of lever? For example, in science or in school days, you must have heard that lever is a tool with the help of which you can take the things up or you can take the things down. That lever which you have must have read in school days and in science, that is lever. So today I will be telling you something about lever, especially to non-commerce MBA students, and I will be telling you something about working capital management. What is working capital? What are current assets? What are current liabilities? What are short-term sources? Why the working capital is required? What are the reasons for working capital? So, dear friends, these two readings and this study session is very easy, very short. So I think we'll be covering these two in 7 to 8 lectures. So let's start today with reading 37, leverages lecture number 1. So please take out your registers and curriculum. I will be showing you practical case studies of Kingfisher Airline. I will be showing you ITC Moria Sheraton. I will be showing you Shubiksha. I will be showing you Infosys, and all those practical cases we will discuss along with the concepts. That what is the meaning of operating fixed cost? What is financial fixed cost? What is sales risk? What is operating risk? What is variable cost? What is financial cost? What is the rule of thumb? Why interest cost is not good? Or what should be followed? What is the meaning of how to calculate operating leverage? All the things we will discuss. Please take out your registers. Please take out your registers, my dear friend. Let's start with the journey. Please take out your registers. And before I'm going to start with, please write a particular point number 1. I have prepared the slides. Just write reading 37, or before that, just see study session 11. We are going to start with lecture number 1. Lecture number 1, study session 11, reading 37 and reading 38, measures of leverages and working capital management. So what the study session 11 covers: how companies make use of leverage. Sahara India, Kingfisher Airlines. We will talk of all these companies. Even Lehman Brothers, General Motors, Infosys, and manage their working capital management. How this? So start reading 37, measures of leverages. There are 5 learning outcomes in reading 37. Only five outcomes. Only 5 outcomes from A to E. It will take 5 to 6 lectures, and there are only 15 practical problems. 15 practical problems as per the CFA curriculum level number 1. So I'm now starting the picture. I'm starting the picture. Now I'm starting the picture, and just you tell me what is the meaning of risk. If I ask you what do you mean by risk? Some people, some students along with CFL level 2, they do a course named as Financial Risk Management, FRM. Risk, what is risk? What is the meaning of risk? How many types of risks are there? When I say risk for a student, for a CFA aspirant who has given examination in June and December, and the result will be within 8 weeks, that is for the June attempt, result will be in the last week of July most probably, and for December the result will be most probably in January last week. Now there is a risk involved in that, that whether that student will clear or not clear, will pass or fail. Risk means something which you are expecting, and that is not happening. The risk is, it is a possibility. I will say it is the possibility. It is a possibility of. It is a possibility of variation in 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 expectations. I will say it is the possibility of variation in your expectations. What you are expecting as your basic EPS for this coming financial year, what you are expecting as diluted EPS as a corporate entity, what you are expecting, that is not coming. What you are expecting, that how much would be the sales, that is not coming. Or the expectations of that, the variation, the deviation in that expectations is named as risk. Risk can be of different types, my dear friends. There can be an earthquake risk, there can be a tsunami risk, there can be a business risk, there can be a sales risk, there can be a operating risk, there can be a financial risk, there can be a political risk, there can be a technological risk in case of Nokia, political risk in case of Patanjali. So as a chartered financial analyst, as a CFA aspirant, this reading has huge importance, because we will be telling you how the lever can make your business either upward, or how this lever can make the business as downward. So what is the lever? What is the cost? What are the involvements in that? So please start writing down. Risk is something, risk is the expectation, is the variation in the expectation. It is a possibility of variation. What you are expecting, and that does not happen. What is a possibility in that? The change in the dollar rate, or interest rate, or the technological risk, the difference in the expectations. So please read down, write first point. Please take out your registers, my dear friend. Please sit straight and write down these things. Risk is the possibility of variation in your expectations. Now, for a finance guy, for a corporate finance guy, I will say risk is the possibility of variation in the return, in return for, because you are expecting a return from a capital writing project, you are expecting a return from a particular industry, you are expecting a something as portfolio investment return, and that does not happen. That is named as a risk for a corporate finance guy. And there are different types of risk. I have written business risk, technological risk. Can you give me examples of business risk? Kingfisher Airline can be a best suited example for business risk. Technological risk, Nokia versus Samsung, now Oppo and Vivo, all these, that is a example of technological risk. Market risk, political risk, Patanjali. Now Patanjali is going up because Ramdev supports BJP, and BJP Prime Minister is there. Now that is named as political risk. So risk is something which is the possibility of variation in expected return. Now, what is the meaning? Or for a corporate finance guy, I'm not interested in political risk, I'm not interested in technological risk, I'm not interested in earthquake risk, I'm only interested in total risk, which is related to that business. Now, when I say total risk, it can be bifurcated into two parts. Prima facie, if I can divide, it can be divided into two parts. One is business risk, and second is financial risk. You have heard of pure play method in the in cost of capital. We were following that. In case of pure play method, there was two types of risk. One is inherent risk due to business model, and second is due to debt equity mixed capital structure risk. So firstly we do unlever the beta, then we relever the beta on the basis of debt equity mix, after tax and all that. So I want to tell you there are two types of risks. Please write down there are two types of risks. If I say for a business entity point of view, total risk is of two types. One is business risk, that is inherent risk, and second is due to capital structure risk, that is balance sheet risk. So please write down this point number two, due to operations. For example, in case of Moria Sheraton, if I see any hotel industry, so many gorgeous looking receptionists are standing there or sitting in the reception. They have to maintain the whole ambience. They have to maintain the bedroom. They have to change the bedroom sheets. They have to change the pillow covers. They have to clean the toilets whether guests are coming or not. It means all hotel companies, they have to incur huge amount of operating cost. Now operating cost can be of two types. It can be variable in nature or it can be fixed in nature. So that we will be coming. But risk is not due to variable. Risk is due to fixed, because they have to pay salaries to those receptionists. They have to incur the operations. They have to incur the clothing expenses of that, pillow covers, bed sheets, and all that. That something is named as operations, and that something is named as operating fixed cost. I repeat, third point, second point, please read down. Please write. This total risk can be divided into two parts. One is due to operations and second is due to debt equity, due to financial, due to balance sheet. So please prepare a diagram like this. Due to business model. And when I say don't write down sales risk, we will see what is the meaning of this. Operating risk is due to incidence of fixed operating cost. Operating risk is due to incidence of fixed operating cost, that is rent, salary, etc. So I will be showing you one case study of Kingfisher Airlines, that how they have incurred so huge cost, and that's why that is the main reason of falling down of Kingfisher Airlines. Just see to it. Just see to it. I'm not increasing the volume because it will come with the
Kingfisher employees out on the streets. The
copyright
Navy has
issue. So
protested
just see to
KFC
it
management
that
for not
uh,
paying
what
salaries
is
even
there
during
in
winter
this
months.
screen.
They demand
License
that the
cancellation is
supervisors are
there.
left in the authorities and
KFC
Indian
license
Railways do not want
cancellation.
to hold any more meetings because meetings are not fruitful. The lender
All these
stipulates
employees are
250 crore
standing.
rupees is a small
Captains,
relief.
pilots,
But
air
KFC
hostesses, they
insists
are
it is
not
simply
getting
not
their
enough.
salary from last so
The
many so
wage bill
many
at Kingfisher is
months.
around 50
KF
crores
60
per
crore to
month.
little wage
Only
bill.
half the employees
Half of the
receive
employees were
March.
paid.
Employees
Now the
due
point
at least
is
130
that
crores.
employees have to be paid 130 crore rupees. Now whether the plane is moving or not, whether there is a flight or not, it hardly matters. Air hostesses will get salary, captains will get salary, and airport authorities will get the amount of rent from the Kingfisher. So whether sales are there or not, it hardly matters. Kingfisher has to, Vijay Mallya has to pay some amount of fixed as operating fixed cost every month, and which is a huge amount of risk. This is the main reason of falling down of Kingfisher. So after this Kingfisher, just see to it. Just write rent, salary, etc. and Kingfisher Airlines, and then prepare a second paragraph. Due to second risk is due to debt equity structure or balance sheet structure, or the how much amount of debt you are using in balance sheet. Financial risk is due to incidence of fixed financial cost, that is interest on debentures. Because if you issue more debt, I will tell you one case story of Subiksha, that because of high debt, that whole empire has fallen down. Because in case of high debt, you have to pay fixed amount of interest, whether you are earning something or not, whether you are doing sales or not, whether you are at beginning stage or middle stage, it hardly matters. You have to pay interest to debenture holders, and debenture holders can go for liquidation to high court also. So, preference dividend in case of cumulative preferred stock, it is necessary that you have to pay preferred dividend in case of profits. So, there is a huge fixed financial cost you have to incur. So, that fixed financial cost is there. So, that incidence due to which that is named as financial risk. So, my dear friends, I will say in a business, in a business entity, there are two types of risks. So, you have written that. Point number three, case study. I will be showing you Infosys, I will be showing you Wipro, I will be showing you TCS, and then we will see that which type of cost. For example, this is IT hotels, More Sheraton in Delhi. Now they have to maintain this structure. They have to maintain this ambience. They have to change their bed covers. They have to change the pillow covers. No, it involves a huge cost whether guests are coming or not. If the sales decrease by 5%, their profits decreases by more than 5% because they have to incur operating fixed costs in any case. So the point is, for example, in case of Infosys, just see that what is the huge cost of Infosys? That is IT company, software company. The huge cost is salaries. They have to pay fixed amount of salaries every month. Whether they are getting any order from USA or not, it hardly matters. Then I will be showing you Subiksha case study after some time period. But please firstly write down, firstly write down a case study so that you can get an idea. In case of IT industry, the biggest cost is salary to employees. In case of IT industry, the biggest cost is that is their operating fixed cost. They have to incur. They have to incur. In case of commission agent, for example, I have just given a contrast. In case of IT companies, they have to incur huge operating costs. But in case of commission agent or the agent who get a commission by with the help of a transaction which is being stuck between buyer and seller. Now, commission agent has not to pay any fixed cost. Now, it depends from business to business that how much is the fixed cost. If I see Apollo tires, there can be a huge amount of operating fixed cost. Maruti Suzuki, they have to maintain the factory plant, they have to employ the employees, they have to pay the salaries, they have to pay the factory rent, they have to pay the electricity expenses, they have to pay the overheads. It means they have to incur huge operating fixed cost. Now it depends from business to business that how much is the operating fixed cost. And in some companies where operating fixed cost is less, because sometimes they go for debt, they have to pay huge financial fixed cost. Now the rule of thumb is that in case you are in a business where huge operating fixed cost is there, then it is better to have, then it is better to have that type of debt equity mix which has lower incidence of fixed financial cost. You are getting my point? So my dear friends, case study. Please write down airline industry. I have shown you Kingfisher Airline. I have shown you More Sheraton hotel industry. So all these examples will help you to clear your concepts. And the rule of thumb is either operating cost should be more or financial cost should be down. If both the costs are more for a human being, if blood pressure is also high and sugar level is also high, then he will go for a heart attack. It means if blood pressure is high, sugar level should be less. If blood pressure is low, sugar level can be high. But both cannot be low or both cannot be high. So there is a rule of thumb. Please write down this point number 3. If you are in that business where there has to be high incidence, supposedly you are in a business where there has to be high incidence of operating fixed cost, rent, salary, etc., then it is better to keep fixed financial cost lower. Then it is better to keep fixed financial cost lower as it is possible. Because it is in your hands that debt can be minimized and equity can be maximized. Because you are in a business where operating fixed cost has to be more. This was the main mistake done by Subiksha. I will tell you the case study. Now the point is there are two types of cost, operating cost. One is variable cost and second is fixed cost. Whether you heard of variable cost and fixed cost, I will be telling you. Just firstly write point number 4. I think you must be writing in your registers. Don't try to be over smart, my dear friend. June, December is very important for you for saving 6 months. This chapter leverages will play a very important role. Mind you, I am telling again and again, please sit straight. Please use the calculators. Please write the concepts. Please prepare the flow charts. It will help you. Practice makes the man perfect. Come on! Following is a flow chart. I have prepared a flow chart for you. There is no need to read so many huge pages of CFA level number 1 curriculum or with smaller fonts. There is no need to have pressure on your eyes. Just write, just read, just write this flow chart. A flowchart as per CFA curriculum number level number 1. For a CFA, for a corporate finance guy, risk can be bifurcated into business risk or financial risk. So I have changed the definition. Earlier I was giving the business the normal terminology, but I am now specific to CFA curriculum level 1. Risk which is related with the entities, that can be bifurcated into two parts: business risk and financial risk. And even business risk can be divided into two parts: operating risk and sales risk. You have, please write down, sales risk and operating risk. Now, what is sales risk? If there is a decrease in the sales, if there is a variation in the sale, if there is a deviation in the level of sales, up and down, because every business has to move from those business cycles. Boom, recession, recovery, boom, recession, recovery. Now, if there is a decrease in sales, that risk is named as sales risk. Now, second is operating risk, because every entity has to incur operating cost, and operating cost can be of two types. One is variable cost and second is fixed cost. What is variable? The cost which is directly related with production is variable, and the cost which remains fixed is named as fixed cost. For example, rent paid, salary paid, printing and stationery expenses, electricity expenses, telephone expenses. You have to pay at least some amount as rent. If you manually see the telephone expense bill, there is some amount of fixed amount of rental which you have to pay. So that fixed amount which is not directly related with production is named as fixed operating cost. But the material cost, but the labor cost, but the variable overheads which are to be incurred or which are directly related with production are named as variable cost. Please write point number 4, most important point. Following is a flow chart which is of worth importance. Risk can be of two types: business risk and financial risk. And business risk is again of two types: sales risk and operating risk. Sales risk and operating risk. And financial risk is interest risk, because you have to pay interest. Please write, my dear friends. Sales risk means decrease in sales. When supposedly my sales will decrease by 5%, but my operating profits will decrease by more than 5%. I will show you in the next lecture the whole mechanism, that why or how, when sales is decreased by 5%, my operating profits will decrease by more than 5%. That I will be covering in video lecture number 2, because that comes in learning outcome B. This time, in this class, we are covering learning outcome A. So sales risk means drop in or variation in sales. Operating risk is when sales drop, then profit might drop at a faster rate. That something is named as sales risks. And operating risk is, due to decrease in sales, my operating profit will decrease at a higher pace. That is named as operating risks. So I'm going to start. I'm going to give you a case study on Subiksha, that how that big company has come to has fallen down. What are the reasons behind that? Subiksha, you might have heard of Subiksha. I'm not talking of Big Bazaar. I'm not saying for Vishal Mega Mart. I'm saying Subiksha. Now, what happened to Sunil Subiksha, a IT guy who has just cleared his college and started with the Subiksha and with a new concept of that chain of groceries, chain of retail shops, where they are selling air conditioners, refrigerators, or any crockery and all that. But that is with the concept of no frill. When I say no frill concept, it means the idea of that gentleman was that we will not incur any receptionist cost, we will not incur any AC cost, we will not incur any interior decorator cost, and that cost which is minimized, that will be transferred to, that saving in cost will be transferred to the customer, and customer will get the refrigerator, air conditioner, crockery at a lower price. In 2001 or 2002, this chain started and grew like anything. But there was one major mistake which is did by that gentleman, the promoters of that Subiksha, that they have borrowed a high amount of debt. No doubt they are planning for IPO, but they have borrowed a high amount of debt, and you know that in case of high amount of debt, huge incidence of debt, you have to pay interest in any case. And in 2008, due to financial crisis, their sales went down. Also due to ERP, they have launched a new, they have started with a new enterprise risk software, and because of those reasons their sales drop down, but they have to pay fixed amount of interest to the borrowers. Because of that reason, that whole big giant company fallen down. So this is the main example of financial risk. Subiksha, please see what Wikipedia is saying in regard to Subiksha. Please see to it. Subiksha was a Subiksha was a Indian retail chain with 1600 outlets selling groceries, fruits, vegetables, medicine, mobile phones. It began operations in 1997 and was closed down in 2009. What happened in 2009? Mismanagement. Owing to financial mismanagement and a severe cash crunch. Due to financial mismanagement and severe cash crunch, owned by R. Subramanian, the company known as which this. No, it means what happened in 19. You must have read this case study of Subiksha. So you will get an idea that how operating fixed costs and how financial fixed costs play such an important role in falling down, rising up of our company. So there comes the importance of leverage. So I am doing today this chapter leverage. So please you have to read this case study. Now please point is just see to me that I am doing the study reading number 37, study session number 11, lecture number 1. I want to tell you that what is the importance of liver, what is the meaning of risk, how many types of risks are there, what is sales risk, what is operating risk, what is financial risk, what are the main real case studies which with the help of which we can understand this. I have shown you so many things. Now the point is, I can say operating risk. I have just mentioned operating risk. Operating risk is due to Operating risk is due to variable cost and fixed cost. I will say the huge incidences due to fixed cost. Now you should know what is the meaning of variable cost. The cost which is directly related with production. That something is named as variable cost. And the cost which remain constant irrespective of production, it is named as fixed cost. And the concepts I will be telling you in lecture number 2. Hope you have 37, lecture number 2. Cost, we have covered cost of capital. Now we are in leverages. Study section 11, reading 37. Leverages, calculation of leverages, importance of leverages, and I want to deliver video lecture number 2, leverages. Let's start with the journey. So today's class will be the most interesting and most technical class. And especially I will be putting more emphasis for non-commerce, engineers, my friend, my students. Those who have come directly from science side, engineers, come on. This lecture will change your attitude of life. Today's lecture is so important. If I want to put star, I will put 6 stars out of 5 stars. So much highly important this chapter is. In today's lecture number 2 of leverages, reading 37, I, myself, Bhupesh Anand, I will be covering learning outcome B. We have already covered learning outcome A. That what type of risk? Risk is the meaning. What is the meaning of risk? Business risk, financial risk, sales risk, operating risk, fixed cost, this, and this. But today, we will be coming to the technical part, how to calculate, degree of operating leverage, how to calculate degree of financial leverage, what is DOL, what is DFL, who is independent, what is the relationship between EBIT and sales, what is the relationship between EAT and EBT, all that dependent and independent relationship we will see. Please take out your calculators. Please take out your register. Hotels, whether it is Kingfisher Airlines, it hardly matters. All the entities have to incur some cost. And cost can be classified on the basis of element-wise, material cost, labor cost, expenses cost, which we have discussed in financial reporting. Cost can be on the basis of department wise, factory cost, office cost, sales cost. And cost can also be determined or classified on the basis of variability. Variability, variability. It means if the cost varies along with production, then it has a separate classification, and if the cost which does not vary along with production, it has a separate classification. So in today's lecture I want to tell you how to calculate degree of operating leverage, degree of operating financial leverage, degree of combined leverage. For that I've already started the grassroots work for you. So cost can be classified as per different ways. The way in which I want to tell you how it can be classified, it is on the basis of variation. Yes, it is on the basis of variation. I will tell you how to calculate on the basis of variation. Variation, on the basis of variation, it can be of two types. One is variable cost and second is fixed cost. When I say variable cost, as the name indicates, the cost which varies, that is which changes, which deviates along with production, that type of cost is named as variable cost. And the cost which remains same, the cost which remains fixed, irrespective of production, it is named as fixed cost. So there are two types of cost, my dear friends. For example, I am delivering a lecture. Now electricity is there. Now this rent of the studio is there. I have to pay rent of the studio whether I do recording or not. There are so many persons standing in front of me. One is editor, one is other person, one is composer. I have to pay them salary whether I do any recording or not. So there are some type of costs which are fixed in nature. Rent, salary to employees, or other overheads, fixed overheads, administrative overheads, which we have to incur. It is irrespective of sales. But the cost which varies with production, for example, raw material, for example, labor, for example, variable overheads, that type of cost which varies with production is named as variable cost. So my dear friends, there are two types of cost. Please sit properly, sit straight, sit straight. Your spinal cord should be straight. Please write down the things. Please see. I will be writing the handwritten slides. Firstly, see and listen to my voice, see my body language. I said cost can be of two types on the basis of variability. One is variable cost and second is fixed cost. When I say variable cost, it means that type of cost which varies with production. And when I say fixed cost, which remains same, which remains fixed, that is named as fixed cost. Now, one student is wondering why I'm telling you what is the meaning of variable cost and what is the meaning of fixed cost. My dear friends, when you are aware that which type of nature this cost is, then it is very easy to calculate leverages and it is very easy to understand the concepts of leverages. So, up to this point, I have just told you the cost which is directly related with production, and the cost which is not related with production is named as fixed cost. So let us firstly write down some slides I have prepared for you. Within that, I have told you what is the meaning of variable cost and what is the meaning of fixed cost. Please open your register. This is my humble request to you. Please open your register. Reading 37, lecture number 2, learning outcome B. In order to understand the concept of leverages, we should know the difference between variable cost and fixed cost in order to understand the concept of leverages. In order to understand the concept of leverages, please write down. Please write down. So I suppose you must have written this. In order to understand the concept of leverages, we should be aware of variable cost and fixed cost. Now, what is a variable cost? I have just told you the variable cost is supposedly electricity cost, or supposedly raw material cost, or labor, direct wages. We have to pay the wages. For example, in the last class, I told you about Kingfisher Airlines that they have to pay salaries. Salaries is again, it depends upon number of employees. So please write down variable cost. It is that type of cost which is directly related to production, that is level of activity. That is named as variable cost, and I have given the examples raw material and labor and wages. So I have given you one case study. Supposedly variable cost per unit is $10. It means for producing one unit. It means for producing one unit. Supposedly the case may be Lakshmi Cement. They have to produce one unit and they have to incur $10. Then if the production is one unit, then how much will be total variable cost? If the production is 10 units, then how much will be total variable cost? If the production is 100 units, then how much will be total variable cost? We have to estimate that. So left hand side production in units, right hand side total variable cost. I can easily calculate total variable cost by multiplying the number of units with the cost per unit. It means as the number increases, as the production varies, as there is a change in the level of activity, variable cost will also change. The cost which changes along with production is named as variable cost, and the angle will be 45-degree angle. As we increase the production, my cost will increase. So this is a graphical representation of variable cost. No doubt it is not specified in your CFA level 1 curriculum, but still if you are aware of this nature and the graph, then I will be telling you the DOL and FOL, that will be more better understood. Point number 3, write down my dear friends, fixed cost. What is the fixed cost? Fixed cost is that type of cost which remain fixed irrespective of the level of production, rent, salaries, that which does not changes. Supposing there is a total fixed cost of $1 lakh. For example, I have given you in the last class I have given you about Subiksha and Kingfisher Airline case studies. They have to incur huge financial costs. In case of Kingfisher, they have to incur huge fixed operating costs, and in case of Subiksha, they have to incur huge fixed financial costs. So fixed costs remain same. Let it be $1 lakh with the fixed cost. Now, whether production is 1 unit, whether it is up to 1 lakh, total fixed cost will remain same. That is the nature. That is named as fixed cost. So the graphical presentation is, it will be parallel to x-axis. That is whatever be the level of production. Even if the level of production is 0 units, you have to incur the cost, and that is named as fixed cost. So let me start with a case study. Now I want to tell you the most important concept that learning outcome B says to us. And for that, I will be taking the example of a case study. Case study I have prepared for you. Let I'm preparing an income statement for you, because fixed cost, variable cost, sales, All this generally appear in an income statement. So I am taking the help of an income statement for understanding the concept of these leverages, the cost. So please write down the example and firstly listen to me. Let the sales be $10,000. I am giving you the original example. Supposingly, this is my original figures. This is my original figures. Now I will compare my original figures with the new figures. Let the sales of a company be $10,000 million. Let the sales of Nestle be $10,000 million, and let the variable cost ratio be 40%. I'm just assuming. Variable cost ratio means variable cost and sales have a relationship. Let it be 40%. It means if sales is 100, then variable cost will be 40. It means if sales is $10,000, then how much will be variable cost? That comes to 4,000. I have assumed it has 40%. So contribution. You see, you have heard first time what the contribution, the word contribution. When I say contribution, I mean the profit. It is not the profit, but it is something which is contributing towards profit. It is something which is contributing towards profit. It is not profit because we have not deducted all the type of cost. Profit is sales minus all cost is profit. Sales minus just variable cost. We are bifurcating variable cost and fixed cost because they have different nature. Variable cost has a different nature, fixed cost has a different nature. So we are bifurcating variable cost and fixed cost. Sales minus variable cost, that is contribution. And that contribution, that profit which is contributing to net profit, that is named as contribution, as the name indicates, less operating fixed cost. I have just told you the nature of fixed cost. Less operating fixed cost, let it be 3,000. It means EBIT, which is also named as operating profit, is 3,000. So please write down these figures because it will be helpful in understanding the concepts. I have assumed sales as $10,000, variable cost as 40%, so $4,000, contribution is $6,000, less operating fixed cost is $3,000, and the balancing figure is EBIT, which is operating profit, that is $3,000. I am standing on this point. I am not contributing income statement up to this point. Firstly, we will clear the concepts. Now, supposingly there is an increase in the sales by 50%. For example, here in the original example, I have taken $10,000 as my sales. Supposingly there is an increase in sales. Supposingly there is an increase in sales. There is an increase in sales by 50%. Then how my income statement will appear? Mind it, you have to prepare this case study because it will help you in solving so many 15 practical problems from the reading number 37. So it is not that you are helping me, it is rather you are helping yourself for saving 6 months. So if the sales is being increased by 50%, no, because due to so many reasons, sales can increase or decrease. Nokia sales has been decreased. Samsung sales has been increased. Supposedly sales is increased by 50%, then $10,000 will rose up to 50%. That comes to $15,000. Now variable cost is that cost which is directly related to the production. Because if sales increases, you have to increase the production, and rate is 40%. So 40% of 15,000 comes to 6,000. Contribution will be 9,000. Earlier the contribution was 6,000, now the contribution is 9,000. Earlier the fixed cost, operating fixed cost is 3,000. Now also operating fixed cost is 3,000 because operating fixed cost is that cost which remains same irrespective of the level of production. The EBIT, operating profit, is 3,000 in original case and 6,000 in the new case. That is when I increase my sales by 50%, 6,000. Now from 3,000 it has increased to 6,000. It means there is an increase of 3,000. Now how to calculate increase? It means there is an increase of 3,000. That is 6,000 minus 3,000 upon original 3,000 into 100. It comes to 100%. It means there is an increase in EBIT by 50%, but there is not an increase in sales by 50%. In case of EBIT, there is an increase of 100%, but in case of sales, there is an increase of 50%. So what is this? If sales is increased by 50%, my EBIT will increase by 100%. Let it be like this. It means 2 times. It means 2 times my sales is being increasing. Now let us find out whether it works in another way also, that if sales is decreased by 25%, then whether my EBIT will decrease by 50%. So I have again assumed something for you. So you have to prepare in the your register, and please take the help of this calculator. I want to tell you some basic concepts. Suppose there is a decrease in sales, that is original. Let the sales be 10,000. Now it has been decreased by 25%, so it comes to 7,500. So I have written there, I have prepared three columns: sales 10,000 original. If it is increased by 50%, then 15,000. If it is decreased by 25%, then 7,500. Variable cost is 40%. So 40% of $10,000 is 4,000. 40% of 15,000 is 6,000. 40% of $7,500 when sales will decrease by 25%. My variable cost will be $3,000, and my contribution will be 4,500, 6,000, and 9,000. And my operating fixed cost, that will always remain same. 3,000, 3,000, 3,000, and my EBIT, my operating profits, is 3,000 for original case, 6,000 for original second change, and 1,500 for third change. Now I want to see whether again there is a relationship of 2. 3,000 to 6,000, it means 6,000 minus 3,000 upon 3,000 into 100. I can find out the change percentage. Change percentage is new minus old upon old. I can calculate change percentage. New figure minus old figure upon old figure into 100. Now please find out for this. 3,000 minus 1,500 upon 3,000 into 100, it comes to 1,500 upon 3,000, it comes to 50%. It means if I decrease my sales by 25%, my EBIT, my operating profit will decrease by 2 times. That is 50%. So it means there is a relationship of 2. Now what is the meaning of this 2? This 2 is degree of operating leverage. By this 2 we mean degree of operating leverage. This 2 means degree of operating leverage. My dear friends, I'm again telling you, please write down note number 1. It is a highly testable area. Now there is 2 times increase or decrease in operating profits as compared to increase or decrease in sales. Because if I increase it by 50%, then my EBIT will increase by 100%. If I decrease by 25%, my EBIT will decrease by 50%. It means there is a relationship of 2. Now that 2 is named as operating leverage, degree of operating leverage. Note number 2. If sales increase by 10%, then my operating profit will increase by 20%. Note number 3. Now this relationship of 2 has a name. So I will give a name. And this is named as degree of operating leverage. Degree of operating leverage. Because we have considered operating fixed cost only. That's why this is named as degree of operating leverage. Degree of operating leverage. Now it can be calculated by 2 methods. I will say first is absolute formula. If only one information is given, if only one income statement is given, I cannot compare with another. And in case I am given with 2 income statements, it means I can compare the variables, the numbers of 2 income statements. Then I will be using a second formula. It means there are 2 formulas. One is absolute formula and second is relative formula. As per absolute formula, my formula will be sales upon EBIT or contribution upon EBIT, one of the same thing. But I have written contribution upon EBIT, $6,000 upon $6,000 upon 3,000. So please write down contribution upon EBIT, $6,000 upon 3,000, that is 2. And in case I want to calculate it by different formula, that how much percentage change in EBIT in sales is there, then how much percentage change in EBIT is there. If I use that relative formula, then my formula will be, now there is no need to learn the formula. You should be aware of which variable is, which number is independent. Now can you tell me which number is independent and which number is dependent? I will say which number is independent. Firstly, there will be change in which number? Firstly, whenever there will be change in a number, that is named as independent, and with the help of that there will be change in another number. It means it depends upon that. For example, sales is independent number, and EBIT is dependent number. So firstly there will be a change, increase or decrease in sales, and with the increase or decrease in sales there will be increase or decrease in EBIT. So firstly there will be a change in sales. For example, I have assumed if sales increases by 50%, then EBIT EBIT will increase by 100%. And if sales increases by 1%, then by how much percentage EBIT will increase? If I use a cross multiplication as we did in school, for 50% change in sales, EBIT changes by 100%. For 1% change in sales, by how much percentage EBIT will change? So what I will be doing, 1% into 100% upon 50%. That comes to 2. It means I can easily calculate the formula also. Now what is 100%? What is 100%? That is percentage change in EBIT. And what is 50%? That is percentage change in sales. So my formula will be percentage change in EBIT upon percentage change in sales. So please write in the formula. I have told you the logic also, that from which I have derived this. So this is the formula: percentage change in EBIT upon percentage change in sales or contribution. EBIT 100%, 100 upon 50 or minus 50. When I take the formula that if it is decreased by this, by 25%. So like this, I can calculate my degree of operating leverage with the help of two formulas. Now I want to move. I want to tell you some interpretations also, because our learning outcome is calculate and interpret. So what is the interpretation of that? The first interpretation is sales is independent, EBIT is dependent. Operating fixed cost will remain same. If sales increases by X percentage, my EBIT will increases by X plus something percentage. It will increases by something percentage. If sales decreases by Y percentage, my EBIT will decrease by Y plus something percentage. So please write down this 6 point. Degree of operating leverage changes with level of sales. It means if there is a change in sales, either increase or downward, there will be change in EBIT. And EBIT is dependent and sales is independent. Degree of operating leverage will decrease at higher sales. If I want to interpret like this, that if sales is increased, then how much is degree of operating leverage? Then it will decrease. If you think from this aspect, from this angle, it is one of the same thing which I have just told you. But if you think from another angle, then this will be the statement. Now I am moving to next degree of financial leverage. For again that I have taken the example or the help of a case study. In the lecture number 1, I have told you that there are two types of fixed costs. There are two types of risk even. One is business risk, that is business model risk, and second is financial risk. When I say business model risk, it has two types of risk: sales risk and operating risk. Second is financial risk, which is due to debt equity, due to capital structure, due to balance sheet. Because we have, in case we have huge debt, as in case of Subiksha, huge debt, then we have to pay huge interest. And interest is a fixed cost. It is a fixed financial cost, because there are three types of activities. One is operating activity, second is investing activity, third is financial activity. Those activities with the help of which we raise finance is named as financial activity. And debt, raising of debt or bond, raising of preference shares, raising of equity shares, it is a financial activity. But out of all these three, interest is a fixed commitment which is to be paid, and interest is a deductible expense that we have discussed in cost of capital. So the point is, I have again taken the help of interest fixed financial cost. Interest cost is fixed financial cost. So please prepare a case study. EBIT, let the EBIT be 10,000. Now I am starting with EBIT. In degree of operating leverage, I have started with sales, less variable cost, contribution, less operating fixed cost. But in this case, we are starting from EBIT, because I want to find out the relationship between EBIT and EAT, EBIT and EAT, EBIT and EAT. That because there is a fixed incidence of fixed financial cost, that is interest. So please write down, my dear friend, this case study. Let in the original example EBIT be $10,000, interest expense be $6,000, EBT is $4,000. My dear friends, I have prepared this and I have already done the hard work. Please write down. Let's take, supposingly tax rate is 40%, then 4,000 of then 40% of 4,000 will be 1,600. Earning after tax will be 2,400. Suppose if I increase my EBIT by 20%. So it can be increased by any percentage. I am just assuming that if there is an increase in sales by 10% and EBIT will increase by 20%. So I am starting from EBIT. If it increased by 20%, then if it is increased by 20%, then EBIT will increase from $10,000, but 20% will be 2,000. So it comes to $12,000. Interest will remain same. 6,000. EBT will be 4,000, 6,000. Tax will be again 40%. 1,600 to 2,400. EAT will be 2,400, 3,600. Find out the change. 3,600 minus 2,400 upon 2,400 into 100. Change percentage is new minus old upon old. New item minus old item upon old item into 100 is equal to change percentage. So figure is 50%. It means if there is an increase in EBIT by 20%, my EAT will increase by 50%. It means there is a relationship of 2.5. So now let's see whether if we decrease EBIT, then whether again the relationship is coming as 2.5. Okay, we will see for that. We will cross check. Supposingly EBIT increases. EBIT, please write out this interpretation. This is the interpretation which I have prepared for you. Now, supposingly if EBIT decreases by 10%, so I prepared three statements for you. 10,000 to 12,000, that I have already discussed, that if it is increased by 20%. Now, if it is decreased by 10%, then $10,000 will become 9,000. Interest will remain same. This is a fixed interest cost. This will remain same. So 9,000 minus 6,000, that is 3,000. Then we have to pay tax as 40%, 1,200. Balancing figure is 1,800. Now I want to find out how much is the change. 2,400 minus 1,800 upon 2,400 into 100. That comes to by how much? 25% decrease. That is 2.5. So it means I have proved that if, now please firstly write down point number 8, then I will tell you what I proved. Now this 2.5, that is the relationship of EBIT and EAT. That relationship, EBIT and EBT. I can also say EBT because tax rate is common, tax rate is variable. So either I can write EBIT with EBT or I can say EBIT with EAT, but in the income statement I have given EAT. So please write down this. The relationship of 2.5 is referred as degree of financial leverage, which can be calculated by two methods. Way 1, EBIT upon EBT. Way 2, that is 10,000 upon 4,000. Again, in this I can say, we can generate the formula also. In between this, EBIT and EBT, which is independent and which is dependent. I will say EBIT is independent factor and EBT is dependent factor. I repeat, EBIT is independent and EBT is dependent. So if there is change, of 20% in EBIT, then I have written then, because EAT is dependent factor, then there will be B change in E B T or E B E A T by 50%. And if there is change in 1% in EBIT, if there is a change of 1%, then 1% into 50% upon 20%, that comes to 2.5. So, my dear friends, you have generated the formula. What is 50%? That is percentage change in EAT or EBT upon percentage change in EBIT. That is 20%. So, same formula you are writing down. So, please write down the same formula. I have prepared. I have given the logic for the same. That how we can calculate that formula. Method 2. Percentage change in EAT upon percentage change in EBIT. That is 50% upon 20% or minus 25% upon 10%. So last point, last line of today's lecture is the most important line. I have written very important. Please write down, my dear friends. I want that you should clear in first attempt. DFL, degree of financial leverage, changes with the level of EBIT. At higher EBIT, degree of financial leverage will be lower and vice versa. I have given you the whole concept. What is the meaning of degree of financial leverage? It means the variation in the increase in EBIT and EBT or EAT. Now, if DFL will change with the level of EBIT, if EBIT will change, DFL will change. EBIT is independent and EBT is dependent. Now, at higher EBIT, DFL will lower because fixed financial cost will be distributed or will be absorbed at a higher level. You're getting a point? So please write down. So this is my point number 9. In lecture number 3, I will be revising whole concept because I have to tell you what is the meaning of combined leverage. I have not told you up to this point because I want to revise the whole concept again in 10 to 15 minutes. So don't miss lecture number 3, video number 3. But before attending that lecture number 3, you should at least again and again here at least 2 times this video number 2. Do the case studies which I have just given to you. Be happy, be jolly, be cheerful, be happy.